Welcome. My name is Robin. I'm a certified financial planner and a certified private wealth advisor, and I'm a wealth manager by profession. Today, I'm going to talk about how rich people avoid taxes with a strategy called borrow and die. Stay with me today. Taxes. We all pay taxes of some sort, whether it's income tax, social security tax, unemployment tax, sales tax. The most common tax that American encounters are the taxes that come out of our paycheck. Now, something that blew me away, and I just learned this in the past 5 years, but this is absolutely true. Of the American population, 40% don't pay any form of income tax. Now, that could be for a variety of reasons, and those people are paying other taxes like sales taxes, Social Security, Medicare, disability, but they're not paying federal income tax. So when people say the rich don't pay enough in taxes, that is accurate to a point. But we also have an issue in American society, believe it or not, with the poor not paying enough in taxes. And there's various schools of thought about that, and there's various schools of thought about making poor people pay more taxes. But when people pay income taxes, they have skin in the game in the society. They're paying for schools, they're paying for roads, they're paying for infrastructure, they're paying for all of the things that we utilize and take for granted as American citizens. So as we talk about the strategy that wealthy people use to mitigate their taxes, just keep that in mind. 40% of the US population does not pay any form of income tax. Let's talk about how the rich use the borrow die strategy to mitigate their taxes. So I'm going to give you a hypothetical situation. There's a 70-year-old man who wants to buy a $7 million jet. One of his assets is a $10 million stock portfolio that he's owned for the past 50 years. There is enormous capital gains built into this portfolio. Let's say of that $10 million portfolio, $2 million was his original purchase and $8 million of that portfolio is capital gains. That means that the client would have to pay on that $8 million state and federal capital gains, which would come to a very, very hefty sum. Also, he has some good stock in there. He got, Amazon at a really good price when Amazon was just starting out. He snatched up a couple of shares of Apple when Apple was just starting, and he wants to hold on to that. He's not really too eager to deconstruct that portfolio and sell it because in addition to paying a lot in capital gains tax, he'll also lose the appreciation on all the great stocks that he's built up over 50 years. So what does this guy do? He borrows and then he dies. Okay. So the borrowing part. A lot of wealth managers and money managers can do this. I often cautiously tell my clients about this because I don't want my clients doing it too often or requesting it too often. But it's something called margin. Margin is basically when you borrow against the value of the stock in a portfolio. Okay, so on a $10 million portfolio, maybe the institution is willing to give the client a $5 million margin loan. There's a lot of ifs, ands, or buts with it, but we're just going to take it at face value. That loan is at interest. So let's say I'm just going to pull a number out of thin air. The client can borrow that money at 5% a year. Okay. So the client is happy. He takes his money and he goes off and buys his private jet. He still has the appreciation on the stock. He hasn't paid the government any taxes, and he just has to pay 5% in interest on that loan every year. And get this, that 5% interest that he's paying on that loan, it's tax deductible. So when you take into account the interest he's paying on that loan is tax deductible, it's at even a lower rate than 5% for him. So let's say Mr. Client enjoys his jet, he lives another 10 years, and at the age of 80, he passes on. By the time he passes on, that stock portfolio has gone from $10 million to $15 million. Okay. And his daughter and son receive the stock in the stock portfolio. Well, guess what? they also receive, they receive something called a step up in basis, meaning the government looks at that portfolio and says, based on the original client's date of death, that is the value of the portfolio for taxation purposes. So the son and daughter don't have to pay taxation on all that growth. And what they just do is they sell some of the stock and they pay off the margin loan that the original client had. So it sounds very complicated, but when you think about it, it's actually very simplistic, and it helps clients circumnavigate a lot of capital gains tax and also losing the appreciation of highly valued, highly appreciable stock. When I tell people about the borrow die strategy, they're like, whoa, 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 that is absolutely crazy. People can pass on millions, hundreds of millions in assets without paying capital gains taxes. I'm like, yes, that actually exists, and people do actually use this strategy. And then the next question is, well, how do I use this strategy? So there's a couple of caveats with this strategy. The reason why I picked the example of a 70-year-old man, you can understand the second part of the strategy, the die part of the strategy. The strategy makes more sense when you're closer to dying, right? A 30-year-old is going to pay a lot more in margin loan interest than a 70-year-old because of life cycle. A 30-year-old probably has another 6 years of life left. A 70-year-old may only have another decade to 2 decades of life yet left. It's typically a strategy used by older clients simply because the die part is more of a likelihood in the near-term future than for a 30-year-old. The second caveat to all of this is that you have to have assets to margin, right? You have to have a stock portfolio, a real estate portfolio, other assets that you can collateralize and that an institution is willing to borrow, to let you borrow against the value of. That knocks out a lot of middle class people, and that pretty much knocks out all poor people. So this is a strategy used almost exclusively by very wealthy people to mitigate taxes. The third caveat in all of this, and I have to explain this very carefully to clients, and I've had this happen to people, and it's bad, it's ugly when it happens. Margin call. Let's say you have a $10 million portfolio and the market drops really, really hard. Let's say it's a really bad year and the market has dropped 20%. The amount of money that you borrow needs to be collateralized, needs to be backed by some asset. And that asset has dropped significantly in value. So what is the bank, what is the institution going to do? They're going to issue a margin call, and they're going to say you have 24 to 48 hours to pay us X amount of money, or we're going to sell stock in your portfolio at random to cover and pay back this amount on the loan. Most people don't want to hear that because they can't come up with large sums of money within 24 to 48 hours, and they don't want the institution going in selling random shares for which they will incur capital gains taxes at the state and federal level. So it's an option and an opportunity to do a borrow die strategy, but there's a lot of caveats, and it's not the perfect strategy for many, if not the vast majority of clients. There you have it, the borrow die strategy that a lot of wealthy people use to minimize their taxes. If you found this information interesting or useful, please like, share, and subscribe.